Oh, hi. How do you buy the stock? I'm trying to be funny on these videos, but it's just not my thing. All right, let's say you want to buy some stock in a company, a couple of shares here and there. One of the things a lot of people say to me is, I wish I could get started, but I just don't have enough money to buy anything. Uh, you know, there's like this conception that you have to have a lot of money to buy stock in a company. You don't really. You can buy one share in a company. You can buy 1,000 if you want, but you can also buy one. So later on, we're going to go on their app and I'll do a video on how to buy and sell stuff on their apps. But in the meantime, on the website, here is how you buy and sell some stock. So here we are. We're on Apple's homepage. You can see it right up here. You've got the buy and you've got the sell. There's something called a bid and an ask. Bid is what people are currently bidding on the stock price for. It's always going to be a little bit less. Now, the markets are closed right now, but it's pretty neck and neck, right? It's off by a couple of cents. Ask is what people are selling it for. So, right, they're trying to sell it for a little bit more. People are trying to buy it for a little less. And these numbers are going to fluctuate like crazy all day as different people are coming in and buying and selling and buying and selling. You're going to list it and you're going to say, listen, I want to spend $2.79.98. I don't want to spend $2.80.05. Why? I don't know. People have weird things, right? Like people want to pay an exact price and it has to be the specific random $2.79.98. It's just how it is. Anyway, when you're ready to buy, what you're going to do is you're going to click on either one of these. You can click buy or sell if you already own the stock, or you can come down here and you can click on the snap ticket. So on the snap ticket, you'll see a couple of different things. You'll see the action, whether you want to buy or sell. You're going to see some other stuff. Buy to cover, sell short. Don't worry about those. You're never going to use them. You are not shorting stocks. You're not covering calls and stuff like that. It gets very complicated. And part of the reason that trading stocks is complicated is because these institutions want your money. They overcomplicate it with all these insane charts and techniques and strategies, too complicated on purpose. So you, the novice investor, go, I don't know, this is also complicated. Here, take my money. You do it. And then they sit there and giggle. So you don't need to worry about any of the complex stuff. It really is as straightforward. I mean, there's a term called EBITDA, which stands for earnings before taxes and amortization and blah, blah, blah. Don't worry about that stuff. It's complicated for a reason. They're trying to discourage you from doing this on your own. They want your money. Anyway, that was a rant. Let's focus now on Apple. You want to buy one share. So you're going to click on buy, and you can edit the quantity to say I would like one. If it doesn't auto fill in for you, you can just type in the ticker symbol. And now over here, you're going to see something called the order type. That's basically what type of order do you want? And you're going to see all these things here, which I'll go over in depth. You've got two choices for when it comes to buying a stock and also selling. Do you want a limit order or do you want a market order? Limit order means you set your own price. It's important to set a limit order on really expensive stocks like Amazon, even like Apple, where within the span of several minutes, while you're debating, should I buy it, shouldn't I buy it, I'm looking at this, I'm looking at that, the stock price can move. You might come in saying, I'm expecting to spend $280, but in the 2 or 3 minutes that you're researching, it could go up $5. Now you're spending $285. Doesn't seem like a lot, but when it comes to selling, it's important that you specify an exact price, right? Like you might buy a stock at $5 and it goes to $5.15. And in all the time back and forth that you're debating and you hit, just sell it at the market, just sell it whatever it's going for, it could be $5.10 again. You're missing out on potential profits. So it's always important to not do a market order. See what happens when you switch it over from limit to market? Price disappears. It's gone. If you just click on a limit and you type in the price that you want, and you'll see them right over here on the bid and ask, right over here where I'm highlighting, you can set the price. $2.85. That means you're going to buy it from some guy who's selling it for $2.85. You could make it whatever price you want. But if you're trying to buy the stock today, it's best to put it in the range where it currently is trading. Your next options are all of these: day, day plus extended, good till canceled, and good till canceled plus extended. Extended means after the market closes. Sometimes stocks fluctuate a little bit. You might be able to, let's say you want Apple today, but you don't want to spend 280. You're saying, hey, if it gets to 276, then you can put the order through. Good till canceled just means that after the market closes, if there's any volatility afterwards, your order still might go through. In other words, if you only say day at 4 o'clock when the market closes, you're done. You might miss out on an opportunity to buy the stock within the next 10 or 15 minutes or maybe even an hour after the market closes. Now let's say you don't want to buy the stock today. You want to buy Apple. You want to buy Apple, but it's just too expensive at these prices. Here you can come over here and you can see the 52-week range. And you can see that Apple was $142 literally almost a year ago. And then it's recently at its new high. Oh, actually, it hit a new high today. Maybe you don't want to buy a stock right as it's hit a new high, right? Usually what happens when a stock hits a new high, everyone finds out about it, it pushes a little higher, and then people take their profits and it sells off. So maybe you're looking at Apple going, I don't want $276. If it gets down to $260, I would like to buy it. But it's very unlikely that Apple's going to go all the way down from 280 to 260 in a day unless something catastrophic happens. So you want good till canceled. Same concept. Always hit extended. You never know, you might miss an opportunity when you're not really paying attention. You always hit extended. And look what happens over here. It puts a date down. Now, they've just picked April 18th, 2020. That doesn't matter. You can put it April 20, 2021. That means, like, you remember those old infomercial things where the guy would put a turkey or a chicken in the oven and close the door and he would say, you just said it. And then he'd point to the audience and they would all go, and forget it. It's the same concept. Good till canceled means you say, I want to pay $260 for this stock. If it ever gets there within the course of 2 years, whatever, put that order in. When you're all done, so I want to buy 1 share of Apple at $260, let it go. I don't care when it happens. Anytime between now and April of 2021, if Apple gets to 260, bing, my order is going to go through. The last thing you want to do is hit review order, which is going to take you here. Oh, what is this? Enter a date between today and 6 months from today. Okay, well, disregard what I just said. I guess I was wrong. Review order, and there you go. My order pops up saying that I can get my Apple stock at $260, and I'm going to get 1 share if Apple gets to $260 within a 6-month period. So whatever I just said about any time in the course of whenever, I was wrong, and here's how you can do it. And when you're all done, you just hit place order, and that's it. Now, since I'm not actually buying this, I'm going to hit do not place. Now we're going to go back and we're going to sell a stock. Now, let's say I've purchased my Apple at $279 because I bought it today, and I am now ready to sell it because Apple has gone to $300, and I would like to take my profit. When it's time to sell, it's the same thing. You go in here, you type in your little symbol, you do a limit order, you say it's $300 today, I would like to sell it at that $300, good till canceled. Not really necessary if you're trading during the day and you see that it's at $300 and you're trying to get rid of it right now. But what happens if you say, it's going higher and higher, but I've got a meeting that I got to go to. Gee, if it gets to 305 over the course of the day plus extended, put my order through. Great. Now let's say you're not really always at your computer. Maybe you are working a full-time job and you don't have the luxury of sitting at your computer or checking your phone all day, every day to see if your stock is where it is or where it should be or where you want it to go. Now, let's say you own Apple, but you say, I bought it at $280 roughly. I expect that stocks will go up and stocks will go down, but I don't want to have a huge loss in Apple. So what I'm going to do is I'm going to set a stop market or stop limit or trailing stop on my stock. The way these work are they're stop losses. What that means is it stops you from having a loss. You can set your stop loss to anything you want. If you do a stop limit, which is what we want, or a stop market, you can say, you know, if my Apple stock that I bought at 279, if it gets to 250, good till canceled. Now we know it's 6 months, not any time in the history of the world. It'll sell. That means you don't have to actively be looking at your computer. You don't actively have to be trading. The whole goal of trading or investing is to minimize losses and maximize profits. I know I say that in almost every video, but I say it because it's true. You want to do a stop market and stop the bleeding, right? Apple's gonna be fluctuating. It's gonna move when there's economic data, trade war stuff. Maybe they have a bad earnings report. Maybe something happens. You want to say, stop it. Now, what are these? Trailing stop percentage, trailing stop dollar amounts. Trailing stops are great on stocks kind of like Apple that are pretty much consistently going. I mean, look at this. It was 142 bucks and now it's 279. If you bought Apple at 142 and you said, you know, if it goes to 135, sell it. Do you want to wipe out all that? If Apple starts dropping, if you let's put it like this. If you buy Apple at 142 and you put in a stop loss saying if it gets to 135, sell it. But then over the next 5 months, Apple ends up, look where it is, at $280 a share. And your stop loss is there at 135, that could wipe out some big profits for you if Apple starts dropping significantly. So what a trailing stop does is it follows the stock as it's climbing. It always keeps that parameter of either $1, if it goes down $5, sell it, or $20, sell it. If it goes down 3% from any price where it currently is, sell it. So a good way to do that is traders usually have a stop loss of anywhere between 1 and 10%. It just depends on how much pain you're comfortable with and how much money you're comfortable potentially losing. You can calculate that. You can figure out, I'm comfortable losing $300. I'm comfortable losing 10% of my money. I'm comfortable losing 1%, 3%, whatever. What you want to do is go here and say if it's 3%, you do that. You type in the 3% that you want. Your parameters are 3%. It's a good till canceled order, and you'll review it. And look what it says. You've got a trailing stop with a parameter of 3%. That means if Apple is to ever go down 3% from any price where it currently is, your order will go through. Do not place. And that's basically how you do it. Well, I'm do not placing it. You're placing it at a time when you have it. Now, you don't always have to do trailing stop losses or stop losses if you're actively sitting at your computer. But a really good reason to use them is because a lot of people don't leave their ego at the door. A lot of people get really emotionally invested in their stocks. And as it starts to go lower, instead of saying, fuck it, I'm getting out, they go, no, this is my stock and I picked it and I researched it and I really like it. I'm holding on. And they end up wiping out a lot of profits. I've done that. I've bought stocks at $10 a share. And a week later it's 9, and a week later it's 7, and a week later it's 5, and a week later it's 3. And I'm sitting there going, oh my God, I've lost 70% of my money because I was an idiot and nobody really stopped to tell me what these stop losses were. If I had known what a stop loss was, if someone said to me, buy the stock at 10, but if it starts to drop below 9, get the fuck out. And you know, it's an important thing to use. You really want to use a stop loss unless you are tough, rip the Band-Aid off. Hey, my stock is going down. I have no emotional connection. I don't want to lose more than 10% or 5% or 3% and I'm out. If you are not able to do that, definitely use a stop loss. If you are not actively sitting at your computer trading every day, definitely use a stop loss. So that's how you buy. That's how you sell. Please like, please subscribe, and have